Hello everyone, hope you guys are well. Today, I want to share my investing philosophy as well as my strategy. With that stated, let's jump into today's presentation. Investing philosophy and strategy. Here are the table of contents for today. I'm going to be sharing the reasoning behind my investing decisions, going over the strategy, also sharing the pros and cons of a brokerage app I use called M1 Finance, talk about my portfolio allocation, and on to the conclusions. And I hope during the conclusion, it reinforces your goals, thinking about our risk tolerance, risk capacity, and also what strategy we want to implement. The philosophy. So currently I believe in the efficient market hypothesis, which means that all public information is instantly priced into the stock, making the stock market overall efficient. However, I do believe that there are opportunities for investors to purchase undervalued stocks through research and fundamental analysis. From past experience and historical data, I find that beating the market over the long term is nearly impossible and that I should invest in index funds with lowest cost possible. And this is also a strategy that Warren Buffett recommends. In his recent letter to Berkshire Hathaway shareholders, he recommended that his wife should put 10% of cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. And this leads to the blueprint I currently follow, which is the index fund strategy. It's a very passive form of investing, and it aims to build a portfolio that mirrors the securities of a particular index, such as the stock market, as a whole, in order to match its performance. And this strategy seems to suit my needs currently because I can mitigate the risk through diversification, and I don't really have to expose myself to volatility. Essentially, indexing allows me to capture the growth of the entire stock market at the cost of less rewards but more stability. An index fund was popularized by this legendary investor called Jack Bogle in 1976. And you guys might have heard of him because he is the creator of Vanguard. And the reason why he created index funds was because he wanted to grant non-institutional investors like you and me to compete with professionals and also making investing easier. In 2007, index funds accounted for less than $1 trillion while active stock assets amounted to over $3 trillion. But fast forward to 2019, more money is invested in passive funds with more than $10 trillion invested. I've tried individual stock picking, but realized that it was a poor strategy in the long run, as it requires a lot of risk and time. I realized time and time over again that there's just no way I could predict the market, and that any gains were heavily correlated with luck. When making investing decisions, I want to make sure I analyze the industry instead of entering a position quite blindly. This will require constant maintenance, which I can't afford at the moment. And another strategy that I followed was dividend investing. The premise of dividend investing is to create passive income and enjoy the benefits of compound interest. Although this is another great strategy, I realized that I don't really need passive investment income, but I need total returns. High dividends doesn't really mean much if you can hold an alternate investment that grows faster. I might dabble again in the future, but currently I feel quite comfortable with index funds. Now let's talk about the brokerage app I use and the reasons why. Currently, I use M1 Finance, a hybrid investment management tool that combines robo-advising and traditional advising. So the combination of these two means that you can choose your investments and automate it. And here are the main benefits and disadvantages of M1 Finance. On the pros, number one, M1 Finance has no fees for trading or account management. This means that we get to save money on each trade that we make and enjoy reaping higher returns. Number two, M1 Finance grants margin loans accessible at low interest rates with $5,000 invested. Their interest rate ranges from 2.25% to 3.75% compared to around 9% national average on personal loans. But you should be aware when using margins, as all investments carry risk. You're not guaranteed that you're going to be making profits on your trade. So the general rule of thumb is that you shouldn't use more than 10% of your asset value as margin, and drawing a line like a cap limit at 30% for margins if you're going to take any loans. Last but not least is the extensive portfolio management customization options. Now that's very wordy, but it's just the amount of tools that it provides. The one being pies and auto investing. So M1's key differentiator is the pie feature, which allows investors to visualize their asset allocations. We're going to take a look at this in a little bit. Investors can either build their own portfolio or select from more than 60 pre-built portfolios called pies. And this customization platform is geared towards investors who want to automate their strategy while also aligning to their personal preference, risk tolerance, and diversification goals. We'll take a look again at the UI, because this is the pie feature. It's one of my favorite tools. In addition to this pie feature is the auto invest feature, which rebalances your holdings. So anytime your cash balance is greater or equal to $25, M1 automatically invests your cash balance into your portfolio. The only thing you have to do when you use M1 is setting the percentages inside the pie. And the pies, it buys fractional shares of the stocks and ETFs you selected to fulfill the percentage target you have set. And fractional shares, if you guys don't know, means, let's say, for example, Apple is currently at $120. You don't need $120. Fractional shares means that if I have $1, I could get a fraction of the stock. I hope that makes sense. It also means that stocks that are underweight is going to be receiving more money, and less money is going to inflated stocks. Another important feature of M1 is that there's only 2 trading windows, making day trading impossible. This constraint emphasizes adopting a long-term strategy and prevents me from making irrational investment decisions. Now on to the cons. M1 Finance does not have advisors and financial planners. Again, M1 Finance has no fees for trading or account management, in part by not having to hire any financial advisors and offering financial services to individual investors. Although we get to reap the low cost to invest in a passive portfolio, you have to figure out what your risk tolerant and what strategy fits your needs. Number 2, we have slow customer service. Although they offer customer service through phone or email, you might not get instant responses. Their phone window is from 9 a.m. to 5 p.m. So if there's any issue with a trade or your portfolio, you might be losing money from the inefficiencies of communication. And third, no tax loss harvesting. Tax loss harvesting is a strategy that helps investors minimize any taxes that they may owe on capital gains on regular income. But M1 doesn't allow for this. Instead, they use a tax minimization feature, which aims to help users reduce the amount of taxes owed when selling securities by selling securities in the order of lowest tax burden to the highest. So here's my portfolio allocation. I've recently changed my portfolio asset location to 80% in the US stock market, 15% in the total international stock market, and 5% in real estate. So M1 Finance currently doesn't offer options or cryptocurrency trading, but once there is an opportunity, I plan to incorporate around 10% into crypto. And before this allocation, I used to have 100% in just US stock market. And I'll explain why I changed the percentages. And the ticker symbols you see below the sectors, it just represents different indexes. And you have to make sure that you do your own research. There are countless more than just these symbols that I wrote. Let's talk about my choices. So when I first saw that I was only holding one stock, like one index, it kind of gave me an illusion. I wanted to put even more stocks, like more slices inside the pie, because it didn't really seem diversified. However, this just isn't true. VTI, for example, it holds 4,070 stocks, and investing into this index fund, I'm investing into 4,070 stocks. That's how you have to think about it. And there's no reason for me to invest in more index funds or more ETFs due to the overlap and the potential of losing returns. So that was my main reason for investing in just one index for the US stock market. That's what an index fund does. And the reason why I wanted to broaden into the international market was for diversification purposes. Historically speaking, international markets tended to outperform US markets. Although the outperformance has its cycles, I believe that with my long time horizon, if US stocks are predicted to have lower returns, international stocks can mitigate that risk. And last but not least, we have 5% in real estate for further diversification. And the reason why I believe in cryptocurrency is that it has the potential to transform the financial industry. The idea of being able to have peer-to-peer transactions without a regulated intermediary is just revolutionary. Although we use peer-to-peer transactions in our daily life through PayPal, Google Pay, or Venmo, these platforms are all regulated and controlled, whereas blockchain is built on a decentralized platform offering a completely transparent system. Although there are both benefits and consequences to a centralized authority, I believe that a decentralized authority in the financial world will be more beneficial through increasing connectivity, speed, and transparency. The utility and value of blockchain technology, which powers cryptocurrencies, I believe can be revolutionary. Now, let's take a look at the M1's interface and visualize my portfolio. But before we move on, I want to share how I got the money. So if we take a look over here, I used to stream on Twitch for 4 years and I made around $13,351. Now this may seem like a lot, but let's look at the amount of time I spent streaming. So 2,136, and if I was working, I would have made around $32,000. So if we do a cost to benefit analysis, I'm not sure if I was compensated. But for me, I don't want that to be like the main premise of all of the things that I do. I really enjoyed streaming. Like, as you guys might see, there's days where I stream for 8 hours a day, and during these phases was where I was going to school and I didn't really perform well, right? What mattered the most is the amount of relationship and the experiences that I garnered from it. It is far more important to me. And also, I'm very fortunate to keep this, as my mom gave me the opportunity to invest. And when you guys are watching my portfolio, or just anyone, I just want to emphasize to not compare with what you don't have. Everyone is at different stages. You have to go at your own pace. When I compare, I deprive myself of joy, and so are you. I want to make sure that I emphasize this point across through many videos, because I have this struggle myself as well. Comparison is just, I think, a part of human nature, especially if we're pursuing the same path. If we want wealth, if we want anything, any hierarchy games we're playing, inherently we're going to compare. But I hope this message, you guys view it as a source of inspiration, or recognizing that I struggle with the same exact thing. But I just wanted to point out where I got this from, and now I want to share my portfolio. If we take a look over here, this is the long-term index fund strategy. I've been holding this for around almost 2 years now, and you could see that over here, 80%. What was this? This was the US stock market, and the ticker symbol is VTI. This is the total international stock market, and this is the real estate funds. And you could see the pie feature. I love this feature because it shows me what M1 Finance is going to do in the future. So right now it is overweight, and the reason is because I added these two categories quite recently. So over time, M1 is going to readjust this and then make a balanced pie. And another thing that I wanted to show you guys was my growth portfolio. And this one, it took me a couple of months to create, and don't get fooled by the amount of returns. I have a 23% return, or 424 gain from this portfolio. And then this is the growth portfolio. And obviously there's a higher return, and you guys might be thinking, wow, this one, this is the strategy that I should follow. And yeah, a lot of it, historically speaking, I think growth portfolios do really well, but it requires a lot of maintenance, and I think I got really lucky. So how I decided all of these individual stocks was based upon PE ratios. I was looking at some of the fundamentals, as well as looking at dividends. So if we take a look Tesla has been doing incredibly well, giving a return of almost 200%. TD Bank 74%. I think these two are the biggest winners. Oh, ExxonMobil 144%, and we also have Chevron. So these are, I believe, are gas. Yeah, they're both oil companies. But I just want to reiterate that this is not the portfolio. This is not the strategy that I want to follow, because it's very correlated with chance and luck. And instead, I plan to reallocate this into my long-term index fund. All right, and I also wanted to share that M1 Finance, if you don't want to create your own pie, there's also expert pies that you could follow. So for example, if I wanted to plan for retirement, I could look at the pie, look at its performance, how it did over the past 5 years, the dividend yield, look at it, see what it's holding as well. So these are all the holdings within. So these are the slices within the pie. And if I just click on add to portfolio, it will be added. Just like that. And then I could add it into one of my accounts. So now back onto our presentation. Now, we also got to talk about our risk capacity, which means how much can you lose? This depends on your time horizon. We have to remind ourselves that compound growth takes a long time. In order to build wealth, you have to extend your time horizon. And risk tolerance is how much are you willing to lose? And this can be mitigated with diversification. And the best way of controlling risk tolerance is controlling what you can, which is consistency, what strategy to follow, and not focusing on the things that are beyond your control. And whatever strategy you follow, I really emphasize on focusing on low cost. The cost of trading should be low to none, especially if you're following a passive one. Low cost broad index fund strategy, it gives you diversification, but also higher returns because you don't have to hire anyone or having active managers. You want a low turnover rate because it means that it reflects a buy and hold strategy. But again, you have to figure out your own risk tolerance, your capacity, and strategy that you want to stick within the long term. Now I want to end with a quote from John C. Bogle. Rely on the ordinary virtues that intelligent, balanced human beings have relied for centuries. Common sense, thrift, realistic expectations, patience, and perseverance. By John C. Bogle. And that wraps it. I hope you guys learned a thing or two from this presentation. And if you guys are already following your strategy, I hope this was a reminder to think about your risk tolerance, your risk capacity, and making sure you're reiterating the strategy that you follow. With that stated, I want to also reiterate that comparison truly is a thief of joy, and I also struggle with it. So I hope that you guys remember to control the controllables and to not compare yourself, but who you are with yesterday. That's another mantra that I want to implement and just embody. Well, thank you guys once again for your curiosity, and I hope to talk to you guys real soon. All right? Take care. Peace.